So, good morning, everyone. Welcome to the online summit. This is a virtual event and we showcase some of our RegTech sponsors. If you haven't met me before, my name's Lily Williams and I'm the Partnerships Manager at BGL and I'll be your host today. So, this session is part of BGL Online Summit, which is a series of webinars that we're going to run across 3 weeks. And we're officially in week 2 of the online summit. Today is our 4th webinar. And today's session, Equities Portfolio Construction Strategies for Advisors, is co-hosted by Bell Financial Group. I'm pleased to introduce today's presenters. We've got Paul, Investment Specialist, and Ryan, National Sales Manager at Bell Financial Group. Bell Financial Group is an Australian-based provider of full service and online broking, corporate finance and financial advisory services to private, institutional and corporate clients. They service over 354,000 clients across the group with funds under advice exceeding $92.1 billion. Their collective strength lies in providing focused investment solutions for all their clients, corporations, institutions, superannuation funds, and individuals. Before we get started with the webinar, I will go through a bit of housekeeping. So the session is recorded. If you need to jump away from the webinar or if you miss anything, you can rewatch the webinar another time. As it is recorded, we will send a recording into your inbox and you can also find it listed in the playlist on our YouTube channel. We do have the Q&A function available. So you'll see in your Zoom toolbar that you can pop any questions throughout the session here and we'll do a Q&A session towards the end. So Ryan, I'll hand it over to you to kick things off.
Thanks, Lily, and thanks everyone for joining this morning. We're really excited to be able to discuss sort of what the Bell Financial Group's about and just really give advisors another perspective on how they can invest for their clients. Obviously with the current landscape in financial advice, we appreciate that there's a lot of ways that you can assist your clients and there's obviously a lot of products that you can utilize. And we're going to talk about some of those strategies that we believe are most advantageous in an off-platform solution. As Lily mentioned, I'm Ryan Davis, National Sales Manager. Within the Bell Financial Group, I represent the Desktop Broker brand, which is an IFA-led execution platform for advisors to trade for their clients. Paul Ashworth runs the online business, which obviously provides portfolio construction and advising services for advisors. I will just note that today's information is general only. And if there's anything that you wish to discuss, you can obviously contact myself or Paul after the session. I thought I would just very briefly what the Bell Financial Group is for those of you that have it of the business and kind of where some of the solutions lie that you may have interest in for some of your clients. The Bell Financial Group is an Australian stockbroking business at its heart. We are Australian listed, but the scope of products and services that are available within the Bell Financial Group probably aren't aware to many of the advisors today. Sorry, we're just having there we go. And I think it's important to understand the 3 divisions within the business. And the Desktop Broker business, which is what we will discuss for you today, sits within our technology and platforms business. We provide access to over 6,000 advisors Australia-wide for them to trade for their clients. There is also a gearing and Bell Potter Capital side of the business, which provides lending within the SMSF and outside the SMSF as well. And Paul's business sits within that technology and platforms business where he provides an execution and portfolio construction service for advisors. As I say, we aren't just a stockbroker. I think it's important to understand the length and breadth of the services that are available to advisors in today's modern world. And this is just a brief list of some of the services that you can access within the Bell Financial suite of services. If any of those are of interest to you, please reach out to us later today. But I guess the point of context for today is that is there another perspective for advisors to consider when trading or creating advice for your clients in a more cost-effective solution, which we believe is on an individual HIN or off-platform basis. That's basically what I wanted to outline today, just to give you some understanding of sort of the length and breadth of the business. Today's session that Paul's going to discuss is, how do you go out and build portfolios when you're dealing with clients that have Australian equities portfolios. And then he'll provide you some of those strategies today. But other than that, Paul, I'll pass over to you.
Thanks, Ryan. Thank you, everyone. Good morning. As Ryan mentioned, Bell Potter Online is the business that I represent, and what we are is we are a intermediated share trading platform that advisors can access for clients. We also have some other transactional capabilities that I'll discuss later, but as a financial planner or as an intermediary, traditionally, if you had a client who came in and had an Australian equities portfolio or wanted to invest in an Australian equities portfolio, you had a couple of options available to you, but unless your dealer group or your licensee fully supported you as far as research goes, sometimes it was difficult for financial planners to be able to offer a systemated and structured service when it came to A, reviewing an existing portfolio of shares, or B, putting together a portfolio of shares that was going to meet the client's objectives or requirements. So an advisor in that sense may have either A, not offered that service because they didn't have the research or the support around them to provide that service, or B, you may have outsourced that or referred that client to a full service stockbroker who would then work with you or without you and manage and maintain that client relationship. So our business came about because of the requirement for a medium somewhere between that, whereby if you're a financial planner out there and a client comes in and has a direct share portfolio, or you wanted to offer direct investment advice, you can lean on a team that provides research and portfolio construction capabilities, but does not take that client relationship. So we don't deal with the end client, we deal with the financial planner. And so what we provide you is a range of portfolio review and construction services, model portfolios, individually managed accounts. But the key factor and the key differentiator with our service is that we don't take that client relationship from you. So we're able to work with you as the planner. You're able to deliver direct investment advice. We provide you with all the research, all the commentary, the basis of the recommendations, and everything you need. And therefore, we can act as your eyes and ears. So you don't have to be looking at the screen all day, worrying about what stocks are doing. If there's anything that you need to know, we're there for you and able to keep an eye on everything for you. So the main types of clients that we see and we assist financial planners with are self-managed super funds. These are typically the trustees who are out there either wanting a low-cost solution, wanting to invest in direct shares or exchange-traded products. They don't want to use managed funds. They don't want to use managed accounts. They want an individually tailored, individually constructed portfolio that suits them, and they're able to maximise the benefits of maybe it's franking credits. That's the typical objective for a self-managed super fund: high levels of income, high levels of franking credits, and low cost. We also do some work for wealth accumulators. Certainly, we have the ability to tailor a portfolio for more growth than income, but certainly the majority of our portfolios are for superannuation funds, and we find that we can tailor specific portfolios that advisors like and clients like. They're easy to understand, and they're low turnover, which is particularly important for what we do and for what financial planners want to do. So what I'll do is I'll run through how we look at the market, the Australian market, how we look at constructing share portfolios, and how we help you manage those ongoing, and how we look at the exchange traded products that are in the marketplace now, because we find that it's becoming ever more confusing between direct shares and ETFs what the pros and cons are for both. And hopefully at the end of this session, you're going to have a little bit better an idea of how we do things, and maybe you can steal some of those ideas and use them for yourself, or alternatively, you can consult with us and perhaps let us help you along that journey. So the first thing we discuss is, I guess, how we pick our investments, and really we're not what you call a value manager or a growth manager. We look at the overarching quality of the business. We look at the ASX 200 only, and we're looking for large cap stocks that have or check these particular boxes. Now, they're not going to tick all of them, but hopefully a majority of them most of the time. So this is not particularly groundbreaking, but we're interested in the underlying fundamentals of the business. That comes first. And so if you were to have a discussion with your client, say, we're looking at high quality businesses that have the ability to ride out various market cycles. So we figure that these are the characteristics we look for. And as I said, these are not groundbreaking by any stretch, but at least it gives you a guide that we're focusing on quality. And then if quality becomes cheap or quality goes on sale, then if you've got a combination of quality and value, then that's the ideal scenario for us. But that doesn't happen too often in the Australian market. So if we're looking at a new portfolio or even an existing portfolio that we're reviewing, an advisor will come to us often and say, this client's got an income objective. This client might be just more of a combination of income and growth, or they've got a pure growth focus and they've got a long-term investment horizon. So we will tailor a portfolio, usually using the ASX 200 as a benchmark or as a neutral starting point. And if we've got a portfolio with an income objective, we'll be seeking securities that provide a diversification in line with the parameters that I'm describing there. 12 to 20 stocks, a minimum and a maximum weighting between 3 and 10%. We want a dividend yield that's higher than the ASX 200 clearly, and we want a beta that's lower than the ASX 200 ideally. So a lower volatility, higher income generating portfolio. And then on the flip side, you've got your growth portfolio, which might be a more volatile portfolio. Once again, same portfolio construction rules, 12 to 20, 3 to 10%, very consistent application across each of the risk profiles. But certainly what that does is provides consistency in the approach. And that's what we believe a lot of advisors struggle with, or SMSF trustees struggle with, is getting a well-structured portfolio to start with. So the unicorn portfolio, which I described there, that doesn't exist. That's the high income, low volatility, high growth, the perfect portfolio that everyone would want. Typically, if you want income, you're sacrificing growth, and if you want growth, you're going to sacrifice some income. So there's a reality that exists in portfolio construction, and what we're trying to do is best tailor it to a specific objective. The unicorn portfolio, as we call it, that doesn't exist. So when looking at the Australian market, we're both unlucky and lucky in some respects, is we don't have the wide array of large mega cap businesses to choose from, as far as what might be present in the US or in Europe or in Asia. But we're lucky in the sense that the top 3 or 4 sectors of our market typically drive a majority of the returns in the ASX 200. So over time, as this table will show, the overall composition of the Australian market from a sector representation perspective hasn't changed a whole lot. So what that means is that we can be fairly consistent in the way we allocate to various sectors in the Australian market. So a typical portfolio will hold 30% financials, 20% materials, an industrial, a healthcare, a real estate stock, a consumer staple, etc., etc. So we spend a fair bit of time concentrating on the top 2 or 3 sectors in the Australian market, and we feel if we can get those right, then that goes a long way to us providing positive overall returns for the portfolios we construct. So if we get a new money portfolio, we're using this as a guideline to sort of how we put together our portfolio, because remembering we've only got 12 to 20 stocks to play with, so we can't own everything. We need to be quite selective, but we need to make sure we get this asset allocation right. And this is what I spend 90% of my time doing in my job, is getting portfolios into line with what the ASX looks like, and then focusing on the high quality businesses within those respective sectors, and hoping that if we pick the best quality businesses, then they will outperform their relevant sector, if that makes sense. And that's how we hope to get our performance, by picking the best quality stocks in the respective sectors, and therefore we feel that they'll outperform. So, to speak to how boring the Australian market can be, quite frankly, is that if we look at the leadership of the ASX 200, say over the last 15 to 20 years, we know that doesn't change a whole lot. And that's good news for financial advisors who want to offer a direct equity solution, because you don't have to turn the portfolio over a whole lot in order to have a strong, robust, well-constructed portfolio that performs well over time. You don't need to get fancy. You don't need to worry about whether the research or the broker research is buy, sell, hold, reduce. You don't have to focus on that too much, because the market's not changing that quickly here. Now, what we've been able to do is backtest these types of things and realize, well, okay, if you'd invested in that portfolio in 2010, say you just bought that at equal weight in 2010, those stocks that I mentioned in that table, and I challenge anyone to go out there and backtest this, how that portfolio would be doing over time. And if you just rebalanced back to the leaders every 5 years, for instance, how well that portfolio would be performing over time, or how that portfolio would be performing over time. Now, I can't put that performance up on the screen because it's really it's just a bit of back testing. But what it does show is that you don't have to stray away from the top 50 or the top 20 or the top 30 in the ASX to have a low risk, well diversified, and a portfolio that performs well. So we take these as the building blocks. We look at this and say, well, okay, let's work around these stocks. Let's think about how we can include some or most of these, and then how can we add some value through reducing correlation, through detecting some early or emerging leadership in the ASX 200 to say, well, okay, well, these are the stocks that are up and coming, and maybe we want to look at that, including those over and above something that's sort of already at the top, and maybe we can get some outperformance that way. But the bottom line is that we're not turning these portfolios over heavily, so we're able to review these once a year, once every 6 months, and not be coming back to you with changes all the time, which is one of the hardest things that advisors, one of the most difficult things advisors struggle with, is trying to keep up with research, direct equity research. It's quite difficult. You can get yourself tied up in knots. So we're sort of trying to strip a lot of that noise out and say, well, okay, well, let's look at the long term. Let's look at the high quality businesses. Let's look at the top tier, and let's look at if we need to be there or we don't need to be there. But some of the things we don't do, and this is also important, is that we don't place an overemphasis on a single research source. Now, this is where a lot of dealer groups or advisors may struggle, is that they're looking at Lonsec, or they're looking at Morningstar, or they're looking at a broker, and they're saying, well, okay, well, this individual analyst doesn't like Commonwealth Bank or doesn't like West Farmers. Okay, well, do we have to sell it? Well, okay, sometimes you do if that's what your dealer group maintains, but what we're able to do is get a confluence of all the research sources and consensus research and form an opinion around that security and a reasonable basis of advice that maybe we don't have to sell it, or maybe we don't have to buy it. So we're not placing an overemphasis on a single research. We don't own all 4 banks in a concentrated portfolio. We don't take larger active risk, meaning we don't have large single stock holdings or large single sector holdings, and we certainly don't sit there quoting Warren Buffett because that's not practical in the Australian equity portfolio context. But an example that I'll speak to here is the regional bank versus the dominant Big Four bank, and this is a discussion that we'll often have with clients and advisors, because if you're a self-managed super fund out there and you're looking for dividend income, if you're running a filter on your retail stockbroking trading platform, one that pops up regularly is a bank, Bendigo Bank. There might be others, but this is just an example. Now, I'm not saying that Bendigo Bank is a bad business at all, but over the long term, despite the fact it might have a very high dividend yield versus CBA, for instance, which has a very low dividend yield in comparison, they're both banks. Well, we will pick CBA nearly all the time. Not all the time, but the majority of the time. We will prefer to support the high quality business that has ticks a lot of those boxes we discussed earlier, over and above Bendigo Bank, which may well be a good business that pays a good dividend, but over the long term, their lack of scale over retail banks leaves them susceptible to underperformance, particularly when there's pressure on the market. Now, we haven't seen that in the banks for since COVID, but certainly we believe that CBA is in a better position to withstand a market downturn than a regional bank. So that's why we'll always gravitate towards something like CBA, which may not be on everyone's buy list because it's overvalued, but it's proven to be the best performer over the long term, and that's really what we want to focus on. So how do we support you? This is an on-demand service, so you can come to us and review the portfolio as often as you like. Most dealer groups have a sort of a 12-month review program, which we support. We'll do a review on a portfolio every 12 months. But if there's something that's happening that you need to know about in between those review cycles, then we're proactive in letting you know. So if there's a corporate action or something that happens that is a need to know for financial planners, then we'll be proactive in letting you know. So you're not going to get a phone call from the client saying, "Oh, well, what's happening here?" Typically, we would have already communicated these things to you.
Do you just want to mention the integration with the reporting systems, kind of like BGL?
Yeah. So that's a good point. We have data feeds set up. So BGL is a very good example of that, particularly for SMSFs. Our platforms support data feeds into your planning software and into your SMSF administration software. So in an off-platform context, you can run all your reports, you can do all your administration, and it's a simple plug and play for us. Now, I'm just going to run through, and so the second half of the session will be more investment specific. So I've given you a bit of the theory around how we construct a portfolio, but I'll give you a little bit more information on how we use ETFs and a couple of stock stories that we'll focus on, and then at the end of that, if you've got any questions, we can sort of address them. So ETFs, they're a massive part of the investment landscape now. It used to be when ETFs were first launched in Australia, they were all broadly large cap passive index following vehicles, and so the main objection that many dealer groups had, or many advisors had, over-managed funds was you don't get any active management. How can you outperform the market? And how can you add value to portfolios? Well, we've seen that outperformance in managed funds is extremely difficult to find. There are some really good fund managers, but in saying that, if you want to reduce risk, reduce active risk, take a more neutral stance on your investment strategy, but with the prevalence of new products that are coming onto the market now, whether it be active ETFs or factor-based or thematic ETFs, we feel that you can construct an ETF portfolio or share an ETF portfolio that will give you the ability to potentially outperform, but also the ability to capture some trends. So if your client has preferences or you have preferences, there are plenty of options out there now for you to access, but buyer beware, because if you've been in the business long enough, you will know that a lot of the ETF product providers are very opportunistic when it comes to launching products. So they will launch a product that's very much fitting the current narrative, the current investment trend, but some of these trends or thematics may not be very permanent, or may really impact portfolio performance if you've got an overexposure to those. So we want to look at how we construct a portfolio, what we look at, and maybe cut out some of that risk and falling for the marketing, not tricks. They're not tricking anyone, but certainly there's some very pervasive marketing out there, and clients will often come to us and say, "Well, what about this new and exciting ETF?" And then we have to sort of break it down and help them understand what the risks are at the time. So to do that, we've been following these quite 5 simple rules. And as I said, these are ideas that you can go and pinch and maybe use for yourself. But we want to see a 5-year track record. Why? Because we've seen many come and go, many ETFs that aren't true, that may not be true to label, or that have really strong short-term performance, but maybe that's not going to last in a long-term strategic asset allocation sense. So we're very conscious of the bid-ask spreads. We're very conscious of how much they're charging. We're very conscious of the turnover in these ETFs. But the most important one I'll focus on is the benchmark that these ETFs often measure themselves against. And so why is the benchmark important? Because there's so many new ETFs out there following custom benchmarks or tailored benchmarks or self-designed benchmarks. Now, these are not necessarily appropriate in an SAA, because you will get tracking error from the indexes. So we're very conscious of how much we allocate to securities that aren't following the most recognised benchmarks, because you will leave yourself open to large tracking error, large amounts of tracking error, if you're not conscious of what benchmark these ETFs are following and how they fit into the portfolio. So we're very focused on that. So the way we'll look at an ETF portfolio is to say, well, okay, what are our core building blocks? What are the ones we like to use in most portfolios? And then we use that as our core. Now, I think there's 6 examples there of ETFs that we might use in portfolios. Not all portfolios at all times, but certainly the way we use them and combine them. They might be considered the core building blocks for a portfolio. And then outside of that, you may want to flex some of your own ideas or some of the client's ideas, but be very careful of how much you allocate to that satellite component of your portfolio. So we're very focused on getting the core right, and that might be 80%, 90%, 75%. Get those core ETFs in there that may offer some sort of style or factor. If a client's got an income focus, well, we want to put an income style ETF in there. If they want growth, we'll maybe put some more emerging markets or something in there. So we can tailor the portfolio very specifically, but we're also very conscious of how much we're allocating to the core, which are our larger index following boring ETFs versus the satellites, and managing that. So we don't become overexposed to sectors, regions, themes, and keep it semi-conservative. So some of the things we're looking at the moment, and how we might overlay these thematics against the portfolios we're constructing. We sort of came up with these at the end of last year. We're still sort of running with these. It's not played out exactly how we would have thought, but for the most part, if we can get most of the calls right, we tend to do okay. So these were the 5 key calls at the start of the year. We're seeing most of these play out, probably 3.5 to 4 out of 5 play out, and we're still sort of following these thematics now. So emerging markets, resources, value, which was often ignored for growth in the last sort of 3 or 4 years in particular, and then looking at the credit cycle as far as interest rates go, bond yields, and the Australian dollar, which is a key factor for international exposure. So for the most part, we're very focused on what's happening in the resources or commodities markets, as far as the industrialization and electric vehicles or data centers and what is being used. So we like in particular copper and aluminium in intensive businesses, and so these are a focus for us, and will continue to be a focus. And some reindustrialization concepts that we're looking to take advantage of. But copper's a big one for us. We see that the copper market is undersupplied in the long term. There's been a dearth of no major new discoveries in many years, and from a development perspective, it takes many years from a discovery to a production for a copper mine. So the leading players in that space now have a decided advantage, and they have the capital to play with. And so we feel that there are a couple of businesses that can really take advantage of that, and one of them is Rio. So we've been in Rio now for about a year and a half, thinking about what type of business they were previously, which is effectively an iron ore miner. They're now diversifying into other commodities, and we believe they're very well positioned to capture this larger trend that we're seeing unfolding. Now, Rio used to be 90+% of earnings tied to iron ore. Into the future, that's going to be 50 to 60 into 2030. So we feel they're well positioned as a good example. And in the energy sector, this is another one we're very keen on. The whole Iran situation has really thrown a spanner in the works as far as energy businesses, but we like Santos over Woodside, for instance, at the moment, given that the capital expenditure programs that Woodside are undertaking currently, that's going to be a drain on their balance sheet, whereby STO, Santos, has gone through a lot of that already. So they're going to be they're going to be better positioned to capture any uptick in energy prices and the subsequent increase in production from the projects they've already spent a majority of their capex on. So this is a good example of how we look at the market. We may not be particularly selling everyone in Woodside and buying Santos, but if we had a new portfolio today, we'd probably prefer to buy Santos over Woodside. And these are the discussions that we'll be having with you, and these are the discussions you'll be having with your clients. So these are not particularly complex or difficult concepts to explain, but this is how we look at, we're looking at particular securities at the moment. And for 2026, these are the key calls. These have been some of the key calls for us, and using Australian equities and ETFs. Some are playing out better than others, but these are good examples of how we communicate ideas to you as an advisor, and what you can share with your clients. And so from a medium-term perspective, at least, we were positive on emerging markets. Those are the vehicles that we're preferring to use in these spaces, resources, value, as we go down the line. So I think most of these are playing out well, perhaps apart from the hedging global equity exposure, which probably hasn't, the strong Aussie dollar probably hasn't happened because of movements in the US dollar, but certainly something we're still thinking about. We don't actively, prescribe hedging or unhedged, but typically we're unhedged. But if we had a strong view on the Aussie dollar, we'd say maybe hedge out a little bit of that. But as you can see, these are not particularly over-sophisticated ideas, but certainly discussion points for clients. And how we support advisors in doing this. So we support financial planners through the initial portfolio construction, the initial portfolio review. We help you open the accounts. We help you implement the portfolios, and we help you with the trade execution. We prepare full proposals. We don't write an SOA for you. Very, very conscious of pointing that out, is we do not write an SOA for you. We don't want to know too much about the client as far as their personal circumstances. We're very portfolio focused. So we look at the portfolio, we give you what we believe is the right idea for the portfolio, and you can go and take that information and incorporate that into your advice document. So we'll give you all the research, all the wording, all the commentary, then you go and take that information and put it into your advice document. So that's a very important distinction to call out. And so from start to finish, we're supporting you through that process. And so if you've got annual reviews, you just come to us, we do a review, and it's rinse and repeat for the most part. But for anyone on the line now who's still online and suffered through that minutiae detail, we also provide a couple of one-off transactional services. Now, deceased estates is a big part of what our team does. We help a lot of advisors, accountants, solicitors work through deceased estate sales, issuer-sponsored sales as well. For a lot of people are important. They've got those small shareholdings, or perhaps not small shareholdings, and they're having trouble getting through to the registry or working out with the registry. We're able to offer those types of services as well. So if you don't have any need for portfolio reviews or don't care for that, then you may be able to utilise Bell Potter Online for your one-off transactions, or referring your estates to us as well. We can help you administer and tidy those up.